And so, as expected, the Bank of Canada reduces the policy rate by 25 basis points to 3% and ends quantitative tightening. What are your thoughts, guys?
Well, tightening quantity, does that mean that they're going to be stopped purchasing bonds?
That's what it means. Essentially, they're going to stop. Purchasing bonds. They're going to stop essentially putting money into the economy or taking money out of the economy.
Yeah. Well, I think that what that means then for fixed terms, right? Because the fixed rates are based off of bond yields. So if there isn't going to be an influx of bond purchases from the government, we might see potentially the bond yields sort of staying flat for the next little while.
Yeah, I mean, that's a good point, right? So variable drops by 0.25%. And I know we hear this all the time is that, well, my variable rate dropped, the fixed rates should be dropping as well, right? Well, that's not necessarily the case. It's going to be $15 for every $100,000 in mortgage borrowed. But the fixed rates aren't based on this decision whatsoever.
Mm-hmm. Now, what I think too, there's a lot of margin there between bond yields and what the banks are actually offering on fixed terms right now. So I think now that the dust is going to settle a bit with the bond yields, that we might see some additional pricing, some additional discounts coming from the banks, from the six major banks. So even though we don't see it necessarily on bond yields, we might actually see it coming from the banks who are going to discount more, let's say today, than they were yesterday or previous months. Again, that's just what my prediction is.
I mean, I think rates do still have a lot of room to come down. I think from our perspective in the mortgage and real estate environment, we still need rates to come down in order to resume the previous affordability, because we're not there yet. Stress test is still limiting people's borrowing resources. So that may come into play. It's not a direct result of a Bank of Canada rate cut. It's not a direct influence on policy rates and fixed rates for mortgages, but we kind of know in the back of our mind that we need it to happen in order to get this market, not even cooking again, but we need to warm it up, right? And we're still, we've taken the steak out of the fridge, but maybe it's come up to room temp, but we got to get that grill fired up now.
So you're comparing the Canadian economy to a cold piece of meat right now?
The housing, real estate and mortgage market. Yeah, for sure. It's the cold meat. It's out of the
throw it in the microwave. That's what you do with your steaks, right?
Well, it's funny. I just saw a TikTok yesterday with someone taking a frozen steak and putting it in the air fryer for 8 minutes, and it was the best steak ever. So
delicious.
Maybe that's going to be
that's maybe
it's going to be the best ever for our market. But one thing I wanted to add is with the U.S. and the Fed Reserve and them reducing interest rates. One thing that really doesn't impact them as much as it impacts us Canadians when it comes to our mortgages is that we have short-term fixed mortgages, right? So 1 to 5 year. So you see how quickly 5 years went by, right? Like COVID was 5 years ago. So a lot of people's mortgages have come up for renewal or are coming up for renewal, whereas down in the US they'll have 25, 30-year fixed terms. So a lot of them haven't been impacted. So I see the reason why the Fed might not necessarily reduce the lending rate, because it's not really impacting a lot of the current homeowners, but it is definitely impacting their purchases. I was talking to our broker owner, Chris, yesterday, and he was mentioning that in the U.S. they had something like 4 million units sold last year, whereas in previous 2021, 2022, it was closer to 6 and above million, right? So they're definitely struggling down in the U.S. when it comes to new purchases and stuff like that. So I guess it's really going to be up to the Fed Reserve down there to balance that out, because if you look at sort of their inflation numbers, there really isn't any need, and their economy, there isn't really any need for them to be reducing interest rates as quickly as Canadian as the Bank of Canada.
And they're not really expected to reduce interest rates there from the Fed. I have read that housing is taken a bit of a slowdown. And you're right about the 25, 30-year terms. So essentially everybody in the US all kind of has the same interest rate at almost any given time, right? Because you can always refinance into the lowest rate possible and then hold on to that low rate for the next 27 years of your mortgage term. And that's really what happens. So they don't have that mortgage interest rate sensitivity that we do on our 3 to 5 year terms that we're constantly having to renew and look at rates, which is largely why I predict, a lower rate environment for a longer period of time, because we hold some of the highest household debt, including mortgage debt, of any country in the world. We can't sustain high mortgage interest rates for a very, very long term with the size of the mortgages that we take out, especially in the GTA and Greater Vancouver markets.
Yeah, I mean, they get locked into their housing, right? So you're not going to move when you've got such, a sub 2% interest rate. You're going to get locked into that, and you're not going to move. And that's why a lot of the U.S. economy or the U.S. housing doesn't move in that same direction. But our rates here in Canada, our fixed rates are really based on that U.S. economy. So if they don't have a need to reduce rates, their inflation's looking good, their job numbers are looking good, we're not going to see the same decline in our fixed rates as because we're so heavily influenced by what happened there. So 25 basis point cut from the Bank of Canada today. The policy rate now is 3%. The variable rate now will be 5.20%. The banks are all expected to cut in that same amount.